everyone, welcome to Santosh Sir classes, and in this video I am going to share you the suggestions of financial management MCO-07 for December exam. And let's see a few important questions which you just can't skip for these exams. Okay, fine, but make sure that you have subscribed to my channel and also share this video to your friends. These are all educational and very useful videos, in fact. So we'll start with Unit 1, Financial Management and Overview, and let's see a few important questions. Maybe it will act as a quick revision for you also. So it's going to be a very interesting and useful videos for your preparation. Okay, friends, in this video, these are all my study materials, but in brief, I have just, written the points, and the explanation part is there in my full study material. So you can purchase that on email or my WhatsApp number, which is provided in the description box of the video. Okay, fine. So you should prepare this. What is financial management? Very simple definition. It is just a management of finance or funds, but it's a very complex function of a financial accountant, in fact, because managing the finance and fund is not an easy job actually. And basically, when we talk about the nature of financial management, we talk about these three important decisions which a manager needs to take. Now, the first one is investment decisions, second one is financing decisions, and third one is dividend decisions. So all these three decisions makes this financial management. And this financial investment decision, it's like allocating funds, like how you are going to invest your funds in different types of assets or investments so that you get the maximum return. So this is again a very complex task for the manager to find out and search for all those lucrative investment opportunities and projects where a company can earn more. Fine. In the second one, it is financial decisions, where all these decisions are considered by the financial manager, like identifying the sources of finance, from where the finance has to be procured, and then cost of raising finance. The interest and all the hidden expenses which are there while raising the finance. And then all these taxes, depreciation, and all these things need to be analyzed properly. Then what is the fund requirement, the amount of fixed and working capital required for the company. So all these are, all this plays an important role. So you need to define all these points. You need to write few lines about this. So my object is to make the concept clear so that you can write in your own words. Okay, fine. When we talk about dividend decisions, it's very simple, like how much the company should distribute dividend to its shareholders. So now completely, like, this dividend depends on the amount of profit that the company has earned during the year, and accordingly it will distribute the dividend to its stakeholders and shareholders. Okay, fine. So the next topic that you should revise for the exams is goals of financial management, like objectives. So basically, this financial function has these five important goals, objectives. The first one is profit or wealth maximization of the shareholders. Now, it is quite obvious because they are putting their hard-earned money into the companies, so the company needs to pay them back with good return. Again, like, the second goal is to maximize the return on the capital. Whatever the capital being invested in the company, so the owner and shareholders, they are liable to get the returns. Then growth in the market value of shares, that is obvious because no company wants its share, the market value of share goes down. So it should be in an upward trend. So that will be a good signal for the growth of a company. And identification of the sources of finance, where a company can raise the finance at minimum cost, at minimum interest rates, and the cost of capital. So we'll discuss this cost of capital. There is a separate chapter for this. So you need to define all these points in the goals or objectives of financial management. Okay, now let's see, like, what are the different roles that a financial manager plays in a company. So basically all these are related with the three decisions just now I told you about. And firstly, like, to estimate the funds required, then to prepare the appropriation of to fix up the appropriate capital structure of the company, to take investment decisions, financing decisions, and dividend decisions, and then allocating the funds in the organization into different departments. Then evaluating the return on capital, that is one of the very basic objective, that is wealth maximization. And to do financial negotiations with the banks and financial institutions while raising the finance. Okay, then to maintain a good relationship with the stock exchanges, that is very important one, to maintain the market value of the shares, in fact, and to increase the profit of the firm and the wealth of the shareholders. So all these 10 are the important functions of a financial manager. But still then there are some challenges faced by by a financial manager. So it can be of three types, like to create the value of the shareholders. I mean, their whatever the investments they have made, so just add little bit more returns on that. So that is called value creation. To understand the psychology of the investors, now again this is a big psychological concept that a manager needs to evaluate the investors or shareholders psychology, what they think about the company. And to tackle the different types of risk, as we know, like these changes in the interest rates and the economic policies of a company and the international policies, so all these things are, they carry some sort of risk, so that needs to be evaluated properly and proper care should be taken for that. Okay, unit 2 you can skip, because quite a lot of questions we got in the June exams. Unit 3 is on valuation of securities, and here this you need to prepare this question, like basic valuation model of securities. And in this again, like you'll be getting one numerical maybe, like, because you need to this is particular formula that you need to solve for the numericals that you are going to get. Okay, fine. Let's see a few more questions. Factors that affect the valuation of securities. So when you are valuing, like how much will be the price of your security, your shares. So a company needs to analyze all these 8 factors, like its nature of business, the demand of the shares, like how much the people like to buy the share of the company, then the past performance of the company in terms of profits and in terms of assets and liabilities, then growth prospect of the company, so what is their waiting for the future, so how about the future of the company, then what about the management of the company, how is the management, how is the board of directors and all the management employees, so how they like to manage the company. Then the all the type of reserves, I mean the accumulated reserves that a company has, I mean reserve fund, capital reserve, and a lot of type of reserves are there, so that also plays an important part. Then the dividend, the amount of dividend declared by the company, and the government policies, so all these factors needs to be evaluated properly before valuing the securities. One more question you can get from this unit is valuation of bonds. So basically bonds are the debts of a company and one of the most important source of raising finance, in fact. Generally people, I mean the companies, they prefer bonds rather than equity shares. And when it comes to the value, like how you will value the bonds, so this is one very simple formula that we use to calculate the value of a bond. And you might get this for numerical. PV equal to 1 by 1 plus r whole to the power t plus tv by n 1 plus r whole to the power of n. So all these abbreviations I've written here, we can note down for the numerical. So you might get this question on the numerical. Okay, fine. The next concept, the next unit is risk and return. And again, a very interesting chapter, in fact. No risk, no return. So that goes the principle. And these are the different types of risk which is there in your syllabus: systematic and unsystematic risk. So you might get one difference between these two. Okay, so again, like systematic risk are of different types. So all these type of risk, they are all systematic risk. And unsystematic risk, again I've written here few examples, and this is the difference that you might get in the exams: systematic risk and unsystematic risk difference. So basically systematic risk arises due to external factors and the company doesn't have any control over this type of risk. And in unsystematic risk, basically it can be controlled by a company, and all these type of risk arises due to the internal working and operations of a company. So on that basis you can write the points of differences. Okay, then comes the concept of return. Now, this is what everybody expect. What return the company is going to give you on the investment, and this is the different types of returns that we generally study in the financial management. The first one is a book return and market return, then single period return and multiple period return. Actually, you can define along with the words that is there, like book return, what is there in the book, so accounting books, and market return is what I mean in the practice what they get, and ex ante return and export return, then security return and portfolio return. So all these different type of returns you might be asked to answer, so you might get in the short notes also. Okay, the next concept is arbitrage pricing theory. Now again, this is a very popular theory. For one theory is capital asset pricing model, CAPM, and this one again arbitrage pricing theory. Basically, it was developed by Stephen Ross, and arbitrage is a process of earning profit by taking advantage of the differential pricing of the same asset. uh, Even like we can write this model in this way, this particular sentence, that security should be sold at a higher price and simultaneously we should purchase another security at a lower price. So this is what the main base of this arbitrage model. So if you want to sell out your securities, your shares, so simultaneously you need to purchase another security which is at a relatively lower prices. So the difference in the prices will give you the return. So that is the basic assumption of this, and you can also write down these assumptions. You need to explain this, right? Okay. Okay, friends, let's move on to the next unit, Unit 5, cost of capital. Now, cost of capital is the total expenses or cost that we incur while raising the capital. And in this unit, you should revise about these different types of cost of capital. These are all there in your syllabus: explicit and implicit cost of capital. Then we have specific and combined cost of capital, and the third one is average cost and marginal cost, and fourth one future cost and historical cost. So there is not nothing much in this unit to study, so just revise this. Unit 6 is on capital budgeting, and capital budgeting in one in fact, and here you should know about like what is capital budgeting. You can get a short note on this. Basically it is making a decision on capital investment. Okay, so all these investments, capital investment refers to investment on plant and machinery, equipment, building and all that. So all these are fixed assets on which the company generally invests, so that is termed as capital investment decisions. And these are all long term in nature, and these are the different processes of capital budgeting. And while deciding about the capital budgeting decisions, the company takes all these five type of decisions. The first one is they generate an idea, okay, what like which type of assets that they are going to buy, and then estimating the cash flows that is required to procure these assets, then evaluating the cash flows, like how like when they invest into that assets, so by what time they are getting back the return, and then selecting a project on, yeah, different types of project are there, and the requirement of this capital for different project is different. So the manager needs to decide, select the project where it can put all these assets into play. Then we have execution of the project. So whatever the project that is undertaken by the company, so it needs to execute that. Then the different types of capital budgeting decisions, these are also termed as project investment. And this question you might get in the exams, very common question. And these are the different types of capital investments that a company make. The first one is on a new project, brand new project. So here also like the company can make the decision. Then expansion of the existing project, then renewal of the existing project, then it can spend money on research and development project, and some exploration project where something new the company wants to explore. So basically it is for the mining sort of companies. And then we have the next question, requisites of a good investment appraisal. Now here, when you are making an investment, so what things, what should be, what type of care that you should take. The first one is, it should be based on the cash flow rather than on the profit or expenditure. So how the cash will inflow and how it will outflow. So all these two things you need to consider. Then cash should be covered for the entire expected life of the asset or project and not for the short term. And it should have an absolute value or gain or loss. And you should consider the time value of money. As we know, the value of money increases with time. So you should consider that after 1 year or 5 years, so what will be the value of money. So whatever the investment that we are making today, so we should consider after 5 years what will be its value. So that is time value of money. Then it should also consider the profitability of the different alternative projects that the company is leaving out. So it's better to make a comparison of the different types of project before investing. Then it should also determine the degree of risk associated with the different types of investment. And as I told you that no risk, no rain. So the company needs to take more risky projects so that it can earn a little bit more profits. Okay. The next concept, methods of capital budgeting. Again, a very, very important concept. You just can't skip this. Revise this term properly. And these methods of capital budgeting involves these three methods. The first one is payback period. The second one is ARR, that is accounting rate of return. And third one, discounted payback. So all these three methods are there for the capital budgeting. So different, you need to define all these three periods, their advantages, limitations, and basically give more concentration on ARR, that is accounting rate of return, very important for your exams. Okay. The next one is unit 7, capital budgeting 2. And here, again, methods of investment appraisal. Again, three methods are here. One is NPP, that is NPV, in fact, net present value method. The second one is PI method, that is profitability index method, and IRR, internal rate of return method. So again, these three are very, very important ones. So you just revise this properly, their advantages, limitations, and all that. Okay. Let's move on to the next question. One more difference you can do in this unit, that is the difference between NPV and IRR. This question is also quite common. Like when you see the previous year's question paper, you will see that this question has come quite a lot of times. One more short note you can revise here, capital rationing. Now here, basically, this term relates to the process of imposing restrictions on the number of new investments or projects that is to be undertaken by the company. So it is something like that. So we know about rationing because we buy product, we our household things from rationing. So this is again in practice for the companies. Unit 9 is on capital market. We know more or less about this. Capital market is a place or a system where these financial securities are bought and sold. And there are different buyers and sellers here, maybe company, government, and general public. And these are the different functions performed by capital market. Now, first one is it mobilizes the savings of the general public. So whatever the money that we save, we can invest that into the capital market to earn more money. And the second one is automatically the prices are fixed. I mean, a very good example is stock market. So where the company issues its IPO at a fixed price, and again according to the demand and supply of the market, the prices keeps on falling or increasing. And third one is liquidity of the financial assets. So we can easily liquefy our assets. We can sell out and raise cash of our investments, and it should be economical. It should not be too expensive to make an investment in the stock market. So all these things are basically monitored by SEBI. So okay, the next one is the difference between capital market and money market. This difference needs to be properly prepared by you. And in capital market, the main participants are companies, banks, and general public. That means we. So we can buy here, we can buy stocks or shares of the companies, but in money market, we just can't buy. The main buyers and sellers here are the RBI, the commercial banks, and no public. And here in the capital market, the main instruments that is being traded are shares, debentures, and bonds. But here, all these treasury bills, commercial papers, certificate of deposits, so all these are made. And in capital market, the tradings are of small amount, but here large amount. These are basically long-term securities, but here short-term securities. That means the company raises funds for short term. Okay. One more difference you can do in this unit, that is difference between primary market and secondary market. This is more easier one. I've explained in my previous videos quite a number of times. Okay, now this concept, the different ways in which a company can issue it IPO. IPO is the like the for the very first time when a share of a company is being offered for the public subscription. So it can do this in five ways. Number one, it can directly offer a sale for the public. That means directly through stock exchanges. The second one is it can sell through firms. The professional firms are there, maybe like broker firms. So through them also company can sell its shares. Then secondary stock issue are there. Again, they are also professional firms, so they also help the company to buy and sell shares. Uh, then we have security auction. It can make an auction of the securities, and the highest bidder gets the shares. Then it can also transfer shares to its eligible shareholders. So that is also one way to issue IPO. So all these things need to be explained. Let's move on to the next one, stock exchange. We know this term. It is a place or institution where securities are bought and sold, just like capital market. So it is a capital market only. And these are the different types of roles and functions performed by a stock exchange. It provides liquidity to our investment. We can buy and sell security at any time that we like. And it helps to fix up the prices of the shares and stocks. It makes our investment more safer because all these are controlled by SEBI and the government of India. So it always ensures that our investment are in the safe hands. There are no fraudulent activities. Fourth one is economic growth of the country. So this is again a very important motto of the stock exchange. And speculation, it keeps a check on the speculation activity of the people, of the brokers and all that. Okay, now let's see like who regulates all these stock exchanges that is in India. Basically in India we have two important stock exchanges, BSE and NSE. BSE is more older than NSE. And now let's see the important the institutions which regulate these three institutions. The first one is SEBI, the Security and Exchange Board of India. It acts as the pioneer institution which monitors the functions of stock exchanges in India. Then we have RBI, Reserve Bank of India. It also controls and puts guidelines for these regulations. And NSE, that is National Stock Exchange. So these three important institutions, they regulate the working of the stock exchanges in India. You might get a short note on this also, like SEBI. Again, like you will know about this, and quite a number of times I have described this in my previous videos also. Okay. The next one is Unit 10, lease financing, and from this you should know what is this lease financing. Basically, a lease is a contract whereby the owner of the asset grants to the other party the right to use the asset for a fixed number of time in return for the payment of rent. So that is called lease. So it is just taking the asset for rent purpose. And this difference also comes quite a lot of time in the exams, the difference between leasing and hire purchase. So this difference needs to be revised properly. Some benefits are there and some disadvantages are there of this lease financing. Benefits, risk of ownership of the asset can be avoided when we take assets on lease. Then there is a convenience of payment. We can pay the rent periodically, so that will not act as a burden. And there is a tax advantage. The government provides some tax benefits on the rent or lease. Some disadvantages are there. It is a bit expensive when you think in term of long run. And some strict actions can be taken against the defaulters who just can't pay the lease on time. Then lesser loses the economic value, because the lazy, he uses the asset, so he is less bothered about the value of the asset. So gradually, when we use the asset, its value gets depreciated. So that is one loss for the leaser. Then risk of obsolescence, that means it gets older, so its value gets decreased. Then there in India, like we have a lot of competitions for this lease, so that is also one disadvantage of this. And the lack of qualified personnel who can manage all these lease properties. So these are few important questions up to unit 10. And in the next video I'll be sharing the rest of the important questions from the units. So thank you very much for watching this video.